You are staring at two different balance sheets, trying to mash them into one, and suddenly nothing balances.
Oh, yeah, it's a nightmare.
Right. Your brain is swimming in fair value adjustments and eliminated balances, and you just want to pull your hair out.
I mean, we've all been there.
Definitely. Whether you are a 23-year-old listening on your morning commute, dreading your upcoming exam, or, a 38-year-old professional on your lunch break, staring down a massive quarterly report, you know this exact feeling of financial information overload.
It is, it's just incredibly overwhelming.
It really is. But what if creating group accounts is actually just a simple illusion? Like a financial magic trick you can master by following one golden rule.
Well, it really is a complete shift in perspective. Once you see the underlying logic, the mechanism behind the math, all that frustration just kind of evaporates.
Evaporates into thin air.
Wow.
Welcome to the deep dive. Today, we are looking at a stack of exam materials, accounting standards, and real-world scenarios to decode a notoriously tricky subject.
It's a big one today.
It is. Today, we are covering the FFA exam topic, preparing a consolidated statement of financial position. We will break it into 3 parts, look at a real-world example, and finish with 3 exam tips you can use immediately.
Perfect. So, to start, let's get a cognitive baseline. The absolute simplest definition is this. Preparing a consolidated statement of financial position means adding together the assets and liabilities of a parent company and its subsidiary as if the group were a single entity.
A single entity, so you're basically pretending 2 companies are just one company.
Exactly. Just one single company.
Okay, let's unpack this with a scaffolded analogy to really ground it. It's like 2 people moving into a house together.
Ooh, the roommate analogy.
Yeah, you know it. You combine your furniture, your kitchen supplies, literally everything.
Yeah.
But if you owe your new roommate $20 because they bought dinner last night, you don't list that as a household debt to the outside world.
Right, because you owe it to someone inside the house.
Exactly.
Mm-hmm.
When you combine your finances to see how the household is doing, you just cancel that internal $20 debt out.
That's spot on. To the outside world, your household does not owe $20. You are presenting one unified economic face. But here is the surprising fact, the part that always trips people up.
Okay, lay it on me.
When you consolidate, you must include 100% of the subsidiary's assets and liabilities, even if the parent company only owns a controlling 80% share.
Wait, let me push back on that.
Sure.
We include 100% of the assets even if we don't actually own all of them. I mean, if I owned 80% of a business, shouldn't I only claim 80% of its delivery trucks and its cash?
I know, logically that feels right, but from an accounting perspective, it makes sense because of control.
Control.
Right. You might only own 80% of the equity, but as the parent company, you control 100% of the subsidiary's operations. You control its cash, its buildings. You get to decide exactly how all of those assets are used on a daily basis.
Oh, wow. Okay, I see.
Yeah, the definition of consolidation is really about wiping away internal legal lines to show what the group as a whole controls and owes to the outside world.
That is a massive distinction.
Yeah.
We are prioritizing actual economic control over just, legal ownership percentages.
Absolutely.
Which brings us to a bigger question, really. Why is this so critical to master? Because before we jump into how to pass a test, we need to understand the real-world application here.
Right. For the senior professionals tuning in, you already know that investors, analysts, and market regulators, they need to see the true economic reality of a corporate group.
Because otherwise they're just flying blind.
Exactly. If a company could just hide all its bad debts in a subsidiary or, artificially inflate its revenue by selling things back and forth to itself, the financial statements would be completely useless.
Oh, yeah. Total corporate shell game.
Exactly. Consolidation prevents that shell game. It forces total transparency.
And that transparency is exactly what they want you to prove you understand on test day. There are 2 reasons examiners love this. Here's the first.
First, it tests your ability to spot inter-group transactions that need to be eliminated. That's the roommate's $20 debt we just talked about.
Right. You have to find that debt and erase it.
Exactly. And second, it tests how well you handle the fair value adjustments of a subsidiary's assets at the exact date of acquisition.
Fair value adjustments.
Yeah. Examiners love seeing if you can spot hidden value that isn't explicitly written on the old balance sheet.
So the examiner is basically testing our ability to spot financial photobombers and edit them out of the final picture while also making sure the background is fully in focus.
That is a perfect way to look at it. You are editing the picture, so only the truth remains.
Okay, there are 3 parts to this. Let's take them one at a time. Part 1 is all about the actual assets and liabilities.
Right. So when you are looking at the statement, the mechanism here is actually pretty straightforward. You take the parent's assets and the subsidiary's assets, and you literally add them straight across.
It's line by line.
Yep, line by line. Property plus property, cash plus cash. You do the exact same thing for liabilities.
Okay, that seems easy enough.
It is. But as we established with the roommate analogy, you must eliminate any intragroup current accounts. If the parent owes the subsidiary money, or vice versa, you completely erase both the payable and the receivable from the consolidated statement.
Okay, simply put, you combine all the assets and debts, but wipe out any money they owe each other.
Perfect summary. Now, part 2 is where things shift away from the simple math.
This is where it gets tricky.
A bit, yeah. This is the equity and goodwill section. In the consolidated equity section, you do not add the subsidiary's share capital and share premium.
Wait, you don't add them?
No, you only show the parent's share capital and share premium.
Let me pause you there to make sure we don't lose anyone in the jargon. Share premium just means the extra cash investors originally paid over the face value of the stock, right?
That's right.
And we only show the parent's equity because if we showed both, we'd essentially be double counting the investment.
Spot on. Think about the actual mechanics of it. The parent used its money to buy the subsidiary. So on the consolidated sheet, the parent's investment line item is removed completely.
It just disappears.
It disappears. And in its place, we recognize a brand new asset called goodwill.
Goodwill. I hear this term all the time.
Right. Goodwill is the premium paid on consolidation. It's the difference between what the parent paid for the business and the fair value of the subsidiary's identifiable net assets.
And just to clarify for everyone, when we say identifiable net assets, we're basically talking about the tangible things we can point to in value, right?
Yeah.
Cash, the inventory, the buildings, minus their debts.
Exactly. If you pay more than what those tangible things are worth, you're paying for their brand, their customer base, their reputation. That premium is your goodwill.
Got it. Simply put, the parent's investment turns into goodwill.
Exactly.
But what happens to the piece of the subsidiary the parent didn't buy? Because we said earlier they might only own 80%.
That leads us directly into part 3, which is non-controlling interest, or NCI, and retained earnings.
NCI?
Yeah. Because the parent didn't buy 100% of the company, you have to account for the NCI. That is the specific portion owned by outsiders. You must calculate their specific share of the subsidiary's value.
Right, because someone else still owns that 20%.
Exactly. And then we tackle the retained earnings, which is basically the accumulated profits.
Okay, how does that work for the group?
Well, for the consolidated group, the retained earnings calculation includes all of the parent's own retained earnings, plus only the group's specific share of the subsidiary's post-acquisition profits.
Hold on, why only post-acquisition? Why don't we get to claim the profit the subsidiary made before we bought them?
Because that pre-acquisition profit was already baked into the purchase price.
Oh.
Yeah, you paid for it when you bought the company. You only get to claim the new wealth generated after you took control.
That makes total sense.
Yeah.
You can't claim credit for money they made before you showed up. Simply put, carve out the outsider's slice and claim your share of the new profits.
So to bring that together, you combine the assets, swap the investment for goodwill, and carve out the equity belonging to the outsiders.
Let's ground this in reality because the abstraction can get really heavy.
It definitely can.
Concrete examples reduce the cognitive load. We have a great global real-world scenario from our sources. Let's look at Singapore Co. and Marina Bay Co.
Okay, let's dive into it.
The scenario is this. On January 1st, 20X1, Singapore Co. paid $90,000 for an 80% controlling interest in Marina Bay Co.
Okay, so to tackle a scenario like this, you have to do a slow, deliberate walkthrough. Don't rush to the final statement.
Right, take it step by step.
There are 5 standard workings or calculations you must process step by step. Step 1 is mapping the group structure. Singapore Co. acquired an 80% interest 2 years ago.
So they own 80%.
Right. That leaves you 20% non-controlling interest, or NCI.
Okay, step 1 is just establishing that 80-20 split so we know who owns what. Before we can figure out if Singapore Co. got a good deal, we have to know what Marina Bay was actually worth when they bought it. How do we uncover that?
That is step 2, calculating the net assets of the subsidiary. We need to know what Marina Bay Co. was worth at the exact date of acquisition and what they are worth now at the reporting date.
Okay, so then and now.
Right. At acquisition, Marina Bay had $15,000 in equity shares and $25,000 in retained earnings. But here is the catch.
There's always a catch.
Always. They had an unrecorded fair value adjustment on their land. The non-depreciable land was actually worth $25,000 more than what was written on their books.
Wait, how can land just have a hidden value of 25 grand? Isn't its value right there on their balance sheet?
This is a crucial concept. Land on a balance sheet usually just sits there at historical costs. That's whatever price the company paid for it 20 years ago.
Oh, like they bought it in the 90s and just left that price on the books.
Exactly. But when you acquire a company, you don't care what they paid 20 years ago. You care about what that land is worth today. That is its fair value.
Okay. So we have to add that $25,000 fair value adjustment to their net assets at acquisition to reflect reality.
Yes.
That means their original equity plus retained earnings plus the land adjustment gives them true net assets of $65,000.
Exactly. Now fast forward 2 years to today. Over those 2 years since acquisition, Marina Bay Co.'s retained earnings grew from $25,000 to $40,000.
So they've been busy.
They have. That means they generated a post-acquisition profit of $15,000.
All right, let's take a breath to recap. Step 2 gives us $65,000 in net assets at the time of purchase and $15,000 in new profit generated since then.
Spot on.
Now that we know their true value, how do we handle the fact that Singapore Co. probably paid more than it was worth?
That brings us to step 3, calculating the goodwill. To find goodwill, we compare the total value of the whole business against the $65,000 fair value of those net assets we just found.
Okay, walk me through the math.
So Singapore paid $90,000 for its 80% share. We are also told the fair value of the 20% NCI, the outsider's share at acquisition, was $20,000.
Could we add those together?
Yep. You add those together, the $90,000 paid plus the $20,000 NCI, the total value of the business at acquisition is $110,000.
I see. So the whole pie is valued at $110,000. But we just figured out the actual tangible net assets were only worth $65,000.
Right. So $110,000 total value minus $65,000 in net assets leaves us with a gap of $45,000.
And that gap?
That extra $45,000 is the premium. That is our goodwill arising on consolidation.
Spot on. So they paid that 45 grand premium for Marina Bay's location or brand or, synergy.
Exactly. Step 4 is establishing the non-controlling interest at today's reporting date. We know the outsider's share started at $20,000 when the acquisition happened.
Right.
But they don't just sit there. They own 20% of the company, which means they own 20% of that new profit Marina Bay just made.
Right. They get their slice of the pie. The new post-acquisition profit was $15,000. 20% of $15,000 is $3,000.
Perfect mental math.
Thank you. So we add their new wealth to their starting $20,000 value, which means our NCI at the reporting date is $23,000.
Which brings us to the fifth and final working. Group retained earnings. This is the parent company's piece of the pie.
Okay, so let's hear it.
The parent, Singapore Co., has its own retained earnings of $100,000. But they also get to claim their massive 80% share of Marina Bay's $15,000 post-acquisition profit.
80% of $15,000 is $12,000.
Right. Add that $12,000 to the parent's original $100,000, and your group retained earnings are $112,000.
Wow. So we have all our pieces, and then we just build the final statement. We add the property, plant, and equipment together. We add the current assets together.
Yep, put it all together.
But there is one final twist in this scenario to tie it all together. At the reporting date, Singapore Co. is owed $5,000 by Marina Bay Co.
Ah, yes. This is the roommate's $20 debt scaled up.
Exactly.
It's the intragroup balance. Marina Bay has a $5,000 payable, and Singapore has a $5,000 receivable. When we consolidate, we must eliminate this $5,000 from both the group's total receivables and the group's total payables.
If you're listening to this on your commute right now, just picture taking a giant red marker and literally crossing out an internal invoice. The company cannot legally owe itself money. You have to edit it out.
And for the senior professionals listening, look at how that $25,000 unrecorded land value drastically changed everything.
Oh, absolutely.
If you missed that hidden asset value during an acquisition, your goodwill calculation would be entirely wrong, your asset base would be undervalued, and you wouldn't be reflecting the true economic reality of what the parent company actually bought.
And that right there is exactly what the examiner is testing when they ask about calculating goodwill and adjusting for intragroup balances.
That's it.
They want to see if you can handle the mechanics of the illusion without getting lost in the noise. But even with these steps laid out so cleanly, things inevitably go wrong on test day.
Oh, they do.
What is the single biggest trap here? What's the mistake everyone makes?
The single most common mistake students make, without fail, is putting the non-controlling interest, the NCI, in the liabilities section of the statement.
In the liabilities section, I can completely see why that happens, but let's explore the metacognitive reason. Why does our brain automatically default to calling it a liability?
Because of the way we are wired to think about ownership. Students look at the NCI and their brain says, well, we don't own this 20%. It belongs to someone else outside the company.
Right.
Therefore, it is a debt. It must be a liability we owe to them.
It makes sense intuitively.
It's a very natural, almost instinctive assumption to make when you are rushing through a timed exam.
But it's fundamentally incorrect. We don't owe them anything.
Completely incorrect. NCI is part of equity. It represents ownership, not a debt. The minority shareholders own a piece of the net assets. The parent company doesn't owe them that money like a bank loan. They are co-owners.
Treat the NCI like your weird cousin who owns 20% of the family beach house.
I love that.
They are still an owner, not a mortgage lender. They go in the ownership section, the equity section. If the house burns down, they lose their value just like you do.
That is exactly it. They share in the risk and the reward. If you remember that NCI is equity, you will save yourself so many lost marks on this exam.
Okay, we've covered the mechanics, the hidden value, and the pitfalls. Let's get you ready for test day with some actionable advice. 3 things. Here's number 1.
Number 1, always prepare a group structure working first to map out the percentage of ownership and the exact time acquired.
Do not skip this step because you think you can hold it in your head.
Never skip it. It dictates everything from your NCI split to exactly how many months of profit you are legally allowed to consolidate.
It sets the compass for the whole problem. Get the structure wrong, and every subsequent calculation is poisoned. What's number 2?
Number 2, when you eliminate an intergroup balance, you must remove it from both the current assets and the current liabilities. It is a double entry adjustment.
Both sides.
Yes. If you only remove it from the receivables and forget to adjust the payables, your balance sheet will simply not balance.
And you will be pulling your hair out with 2 minutes left on the clock. The red marker has to cross out both sides of that internal invoice. Every action has an equal and opposite reaction. And number 3.
Number 3, in the AFAFA exam, remember the equity section of your consolidated statement will only ever contain the share capital and share premium of the parent company. Never add the subsidiary share capital to the parents.
Because if you do, you are double counting the investment.
Exactly.
Remember, you are creating a single economic reality. Ignore the legal boundaries and wipe away the internal lines. For everyone listening who is 22 and prepping for this exam right now, don't let the sheer volume of data panic you.
Just breathe.
Yeah, just follow the 5 standard workings we discussed: group structure, net assets, goodwill, NCI, and retained earnings. Take them one at a time, and the pieces of the puzzle will naturally fall into place.
And beyond the exam, for those of you leading teams or analyzing markets, mastering this means you can look past incredible complex corporate structures and see the true unfiltered financial health of any group. It is an incredibly powerful analytical tool for cutting through the noise.
You don't have to stare blindly at 2 different balance sheets anymore, trying to force them together. You have the exact formula to seamlessly merge them into one clear picture.
Consolidation is just combining the whole, swapping investment for goodwill, and eliminating what the family owes each other. That is the core of the illusion.
We've assumed everything aligns perfectly in these examples. But consider this. What if the subsidiary uses a completely different accounting policy for its assets than the parent company does?
Oh, that opens a whole new can of worms.
Right. Say one uses straight-line depreciation and the other doesn't. How does that change the illusion of our single entity? Do you have to rewrite their entire history before you even begin?
That's a great question.
Something to think about the next time you look at a massive corporate group's financials and assume it's a perfectly unified picture. Thank you to our global audience for taking this deep dive with us. If you had an aha moment today, or if this finally made the math clip for you, please follow us on Spotify and leave a review. It really helps the show.
Thank you for listening.